Hello there, welcome to this edition of Global Business Africa. It's a fairly interesting day across the African business landscape, and we've got all the details you need to know about. Here's what's coming up. Ahead of OPEC's meeting on Thursday, we'll be looking at what is on the agenda. Who will cut, who will not? Zimbabwe's finance minister has an unenviable task ahead of his country's budget. We'll tell you why. And we'll introduce you to a lady who's quite literally providing the building blocks for Somalia's reconstruction process. What shall we ever do about the Naira? That's a question you're going to be asking for the next couple of days. You see, the day after the 8% devaluation occurred, it plunged to a new record low of 178.85 to the greenback. Now, even after a brief rebound, the Naira is still traded lower than the Central Bank of Nigeria's target of 168 Naira to the dollar, plus or minus 5%. The central bank devalued the Naira and raised interest rates for the first time in 3 years on Tuesday to end losses to its foreign reserves attributable to its efforts to defend the currency against weaker oil prices. Commercial bank overnight lending rates doubled to 20% after the central bank raised the cash reserve ratio for private sector deposits to 20%. Now, dealers said commercial lenders were scrambling for cash in anticipation of the central bank enforcing the new CRR ratio on Wednesday. Over in North Africa, Algeria is urging the Organization of Petroleum Exporting Countries, OPEC, to reach a consensus on how to end the drop in global oil prices. So far, since June, they've fallen by over 25%. OPEC members are meeting on Thursday in the Austrian capital. Algeria's energy minister, Youssef Yousfi, said a collective approach would generate stable solutions. Now, this November 27 meeting is important. It aims to examine the evolution of the market so far this year, the imbalances that caused the drop in prices, and then hammer out a deal to rebalance supply and demand. Oil prices dropped yet again on Wednesday to just over $77 a barrel for Brent crude. Despite the current supply glut, some investors do not expect the oil cartel to cut output during Thursday's meeting. Algeria has 1.2 million barrels of oil a day. Over in Egypt, the Al Futtaim Group will be investing some $700 million in the country over 3 years and pay the government $30.5 million as part of a settlement arrived at last week over a long-standing dispute over the sale of land. Mohammed Al-Makawi, Al Futtaim's Egypt CEO, told reporters the investments would be directed at new projects in the second phase of the company's Cairo Festival City development, and that includes a hotel and new housing units. Here's Yasser Hakim with a look at how Egypt aims to clear a backlog of these kind of disputes.
Al Futtaim's latest plans for $700 million is just a fraction of investments to be injected into Egypt by Arab and European businesses. Egypt was hit by an 80% drop in investments due to violence and security concerns after the 2011 uprising. A set of austerity measures and improved security in the last year encouraged investments back to Egypt. Gulf Arab states led the revival, and more has been pledged this week. A portion, over $1 billion by the United Arab Emirates, will be targeting the underprivileged.
We'll be targeting the poor villages, 60% will be targeting low-income families, and 25% will be targeting women business. The agreement comes in a very crucial timing because it's critical for the social fund to cover all the targeted segments and the tranches in the society, and to do the outreach to all the poor villages. This agreement is expected to create around 197,000 projects and around 167,000 job opportunities, with 49,000 being the projects for females.
Several Saudi Arabian businessmen also established a holding company that will invest up to $20 billion in all sectors.
It gives us a confidence that everything will be okay, the investment in Egypt will be okay, and everything will be fine. Also, we hear from His Excellency that the regime working very hard to correct what is happening in the past. What will be in the future, we hope it is good, I hope it's promising, and the economy in Egypt, inshallah, going to be booming up, inshallah.
Most of the investments are towards major infrastructure projects, the new Suez Canal and tourism. However, complicated investment laws and bureaucracy have always hindered the inflow of investments.
It's a critical stage. Investors have bad experiences with Egyptian laws. Some resorted to courts and international arbitration, while others resorted to leadership to solve their problems. We were promised a total revamp of investment laws so we can feel safe when investing here.
The government has pledged new laws will be announced soon.
There'll
be a revolution in investment laws soon that will be ready for implementation before the economic summit. There will also be a revolution in the administrative sector in Egypt with total transparency that will satisfy all society, businessmen and normal citizens.
The latest flow of investments from Arab countries is a much-needed shot in the arm for the Egyptian economy. And as analysts say, it will encourage investors from other regions to enter the Egyptian market in the near future. Yasser Hakim for CCTV, Cairo.
Now, of course, oil will dominate headlines right across the board today and especially tomorrow when OPEC members do meet in Vienna. Let's check in with Melanie Ralph for the latest update on the core issues that members of this oil-producing cartel will be dealing with later on. Melanie, let's look at this from a public finances perspective. Which OPEC members can keep the public finances healthy at low oil prices and which ones cannot?
Well, although oil exporting Gulf nations have built up large reserve over the last few years when crude traded above $100 per barrel, some investors fear that a sharp decline in budget revenues could trigger a cut in government spending, a key driver of economic growth throughout the region. That's why we're seeing Middle Eastern markets taking a bit of a dive today. But in general, the Gulf will be able to weather the storm. So the likes of Saudi Arabia, UAE, Kuwait and Qatar, all the others like Iran, Venezuela, Nigeria, Libya, they all need considerably higher prices. So they'll suffer if low prices continue for much longer.
Indeed. In the run-up to this meeting, however, Saudi Arabia has been very heavily criticized for its unclear communication on whether or not it supports cutting output. Why is the kingdom playing its cards so close?
Well, analysts I spoke to today said it's not clear why they're being so secretive. Just today, OPEC leader Saudi Arabia and fellow member the United Arab Emirates signalled they were unlikely to push for a major change in oil output at the group's meeting this week to prop up prices. Some economists suspect that by letting low oil prices continue could be a way of pricing competitors outside of OPEC out of the market, preventing, for example, a further loss of market share to North American shale oil producers. But it really isn't clear what game they're playing, but analysts are dismissing any notion of a conspiracy theory to drive down prices to hurt Russia, for example.
Indeed, let's address those conspiracy theories in a bit more detail now. The tensions between US and Russia, the Saudis and the Iranians, how's that going to play out at the meeting tomorrow?
Well, apparently the tensions will have nothing to do with the meeting tomorrow. It's literally just business, certainly between the likes of Saudi Arabia and Iran. Both want to see stable, higher prices and both want market share. So they have a common ground to work towards. What problems that all OPEC members share are grappling with is the issue of production outside OPEC. It's grown a lot faster than expected, which means OPEC is slowly having less control over the marginal supply, and they don't like that.
Indeed. We'll have to leave there for the time being, see what happens in Vienna tomorrow. That's Melanie Ralph live in London. She'll be keeping tabs on developments in the commodities market over there. The South African retailer Woolworths held its annual general meeting in Cape Town amid protesters insisting that the company has to cut its ties with Israel. Now, this meeting came a day after Joburg Court ruled that members of the boycott, divest and sanctions movement in South Africa were not allowed to organize, coordinate or encourage any form of protest action in stores. The court also forced the two sides to sit down and talk to each other before the 10th of December. Now, while the boardroom battle was underway, President Jacob Zuma welcomed his Palestinian counterpart, Mr. Mahmoud Abbas, in Pretoria. When they met, he said South Africa will not rest until Palestinians have achieved full statehood. BDS representatives joined the AGM after they recently bought shares in the JSE-listed business, entitling them to attend.
We asked several questions. We asked questions related to the financial statement. We asked questions regarding the ethical image that Woolworths tries to portray and how it's actually contradicting the position taken to buy from Israel, a country which there are various UN resolutions and various international laws that the country is in violation of. So we asked questions both pertinent to the finances but also to the image, the brand and the ethics of the company.
Since we've gone out there and told people that we've got the interdict to stop the BDS protesting inside Woolworths stores, we've had thousands of customers writing to us and welcoming that decision from the court because they were feeling threatened.
Within the next 24 hours, Zimbabwe's spending plans for 2015 will be made public. The finance minister has the rather unenviable task of trying to fund the budget from a local resource pool that is slowly getting smaller. Now, this time last year, the ZANU-PF-led government forecast GDP growth at 6.1%. In a matter of months, however, that figure had been downgraded to just 3%. Farai Mokutuya has the details.
Zimbabwe's 2014 budget was premised on an income of $4.1 billion. The bulk of that, 92% according to the finance boss, is consumed by recurrent expenditure, especially civil servant wages, which gobble up 81%. Analysts I spoke to are understandably uninspired and expect more of the same.
In general, one can say there is really no capacity for the present administration to somehow come up with an expansionary budget.
Zimbabwe has made capital projects, especially in infrastructure, a key focus of its 5-year economic recovery plan. The high expenditure demand and shortfalls in revenue collections, mainly due to company closures that have eroded the tax base, could mean tax increases. In a midterm fiscal review earlier this year, Chinamasa announced increase in taxes on airtime and duties on imported vehicles, but it still failed to deliver enough income.
One of the things hemorrhaging this economy is a high import bill, which has left many local companies unable to compete with foreign products on the ropes. The owner of this flour milling plant is clear about what he wants in the budget tomorrow, and that's Zimbabwe to close its borders to unnecessary imports.
He says current government efforts to discourage importation of finished products aren't enough.
The economy will not collapse because we don't have enough chocolates. It will not collapse because we don't have imported water. We are importing $30 million US dollars worth of flour into this country. But the government and the banks are failing to raise even $1 million to give as input support to farmers for them to grow wheat in the country. So we have seen suddenly a very painful decline of wheat production in Zimbabwe.
If the country internalized the millions being spent on imports each year, it could reboot the manufacturing sector and create much-needed employment. But critically, Chinamasa also needs to deliver policies that attract new capital flows into the country. Farai Mokutuya, CCTV, Harare, Zimbabwe.
We're still in Zimbabwe. Like many other countries across sub-Saharan Africa, it does face quite a severe energy deficit and relatively high youth unemployment as well. Now, a program run jointly by the government and non-governmental organizations hopes to deal with both problems at once by training young people in the installation, repair and maintenance of solar energy units and providing energy to rural households.
Zimbabwe faces a severe energy crisis. Less than 5% of households in rural areas having access to modern forms of energy. The bulk of the remaining households rely on firewood, which continues to worsen deforestation. Add to that the harsh economic climate in the country that has left many people unemployed. Well, a rural youth solar training project hopes to change this by training rural youth in solar technologies and business skills to enable them to find employment and generate income in the solar energy market. The project will also help address the energy challenges in the country.
This program is helping us as youth as it takes out the dependence syndrome and empowers us as youths on how to use solar energy and renewable and other renewable energies effectively, and also how to make money out of it.
The International Labour Organization, the Netherlands Development Organization, together with the Ministry of Youth, Indigenization and Economic Empowerment, hope to train more than 300 youth across the country. 70% of these trainees will be female.
We are targeting youths who are in various rural districts of Zimbabwe, and we are training them on renewable energy projects so that they are able to be linked to the urban markets where these products can be found.
The acquired skills will address two of the main barriers to the uptake of solar technologies in rural areas. These are the shortage of information about the technology and the lack of expertise to carry out quality installations, repairs and maintenance and troubleshooting. Maria Galang, CCTV.
Let's book a quick run through equity markets here for you, see what's going on across the bourses that we track. Negative numbers coming away from South Africa and Kenya. Markets down there by about 30 or so basis points. The NSE in Nigeria and the EGX 30, however, up by over 100 basis points in total. Keep in mind, however, Nigeria is still firmly in the red as far as the year-to-date gains are concerned. It's down by about 13%. We'll be looking at Kenya's attraction to foreign brands despite challenges in its economic management and security. And our series on industrialization in Africa continues, this time looking at progress in Uganda.
Effects of the austerity measures are evident and were expected. Egyptians, however, seem to be patient about it. But El-Sisi told government he wants to control the prices promptly before people's patience runs out.
Welcome back. You're still watching Global Business Africa from the Kenyan capital, Nairobi. Now, from Porsche to Jaguar to consumer brands like Domino's and KFC and Subway, Kenya has seen an increasing number of foreign brands set up shop on her territory. Now, despite some economic and security challenges, it does seem the opportunities offered by a fairly young population, a growing middle class and robust income levels are still attracting quite a few investors. Despite the current wave of investments, there's a lot more that needs to be done to make Kenya a more attractive investment destination.
Kenya's capital, Nairobi, has drawn some of the world's top brands as new investors rush in to grab the attention of a growing middle class with money to spare. The population of around 41 million, 70% of whom are under 35, and one of the highest English literacy rates in the region, the human resource potential also makes Kenya even more attractive. Cold Stone Creamery, an American ice cream chain, recently opened 3 stores in Kenya. Although not directly set up by Cold Stone International, the brand was franchised by Omnomnom Mauritius Limited in a 10-year deal.
We went to Arizona, where Cold Stone was founded back in 1988, Arizona Scottsdale that is, for training on ice cream. We trained on how to produce ice cream, right from when it's still very low to the end product, which you can see that we have here. And the same knowledge we have transferred, or rather we have embedded it in our staff.
For consumers, the growth and diversification of the market means more variety and an incentive to improve standards.
Competition is good. I mean, it will place a demand on the local brands to up their game, which eventually then the customer gets value for money that they have.
Kiprono Kitoni is the chairman of Kenya's Chamber of Commerce and Industry, which has been leading the push to attract more foreign investors into the country.
Foreign brands, a lot of them, ascribe to global best practice. These are brands, goods and services that have found a place in the international market. And I think the fact that they have chosen Kenya, to position those brands is also a manifestation that we are both ready as a market and willing to really adapt best practice.
Analysts say the presence of foreign brands is evidence that investors are alive to Kenya's economic potential, including recent oil discoveries. American makeup brand MAC Cosmetics recently opened their first store in East and Central Africa at a mall in one of Nairobi's affluent suburbs. The retailer says the majority of their stock was sold out 3 weeks after they opened for business.
We sat on the table and we said, we know this market better than you do. You know the products, you know the brand better than we do, but we know the clientele, we know the attitudes, we know the demographics of this country better than we do.
Economists say governance and corruption issues remain a drag on performance, but that franchising solves the bulk of those problems for the foreign investor.
So I would recommend franchising, especially for things that are proven, really, for businesses that have been proven in US, in UK, in Canada, globally. We are one village now.
While the entry of brands into Kenya is important to its economic growth, unemployment remains high, a key factor in achieving an emerging market status to help attract even more investments, as it will offer much higher buying power. Voldy Carlsa, CCTV.
Now, over the past quarter of a century, industrialization across Africa has essentially slowed down. It hasn't taken off as government has expected. In countries like Uganda, for example, a long civil war and poor or non-existent investments in infrastructure have all hindered industrial growth. Now, given the current political stability, GDP growth and investment flows both have risen, but at a much slower pace than some might have hoped. CCTV's Michael Baleke reports from Kampala.
4 decades ago, Uganda was one of Africa's early industrializers. But despite the fact that the country is rich in natural resources and located within close proximity to other markets in the region, Uganda continues to struggle because of the poorly developed local industry.
I think our biggest problem has been political. We all know President Amin, that's the beginning. Then the sending away all the agents who are actually running a lot of those industries and putting them into indigenous hands. And at that time, really, as Ugandans, we were not ready to run businesses. We didn't know how to.
Political instability and conflict have prevented investors from coming forward. As a result, Uganda's economy lay dormant for over 2 decades. But things are beginning to pick up and the country is starting to see progress.
Forward Going to Excel have come back and they are investing in the country. Then, of course, like the business people, like we are doing manufacturing of steel. We know we can be able to sell within the local market. We can be able to sell within the region because now there's a bit of stability.
Even with this progress, economic analysts say industrialization is still slower than expected. The ability of African countries to establish a competitive industrial sector and promote greater industrial linkages has been hindered by poor infrastructure, which has resulted in high production and transaction costs. Many countries in East Africa are working together to pool resources with the aim of enhancing regional markets and making exports more competitive.
Uganda has every advantage, every requirement to be a manufacturing hub, except infrastructure, the energy, the railway, the roads, the ports. All that does not allow manufacturing to grow the way it should be growing.
Uganda also wants to fast-track progress by creating industrial parks in every municipal town. It's an initiative that has already attracted over 2,000 local and international investors. It is also hoped these new ventures, coupled with growth in the emerging oil and gas sector, will create jobs for thousands of young unemployed people in Uganda. Michael Baleke, CCTV, Kampala.
Quick status check on commodity prices here for you. Crude oil falling, of course, from the 80-ish levels that it hit yesterday. Brent crude was down to about 77.53, down about a percentage point or so in trading today. We'll see how OPEC's meeting tomorrow and the decisions coming out of Vienna will influence the prices of Brent crude and WTI later tomorrow. In 60 seconds, we'll introduce you to this amazing young lady. She's providing the building blocks for Somalia's reconstruction. All that and more is coming up next. Welcome back. Now, we've spoken before on this very program with you about the reconstruction that's happening in Somalia's capital, Mogadishu. As security improves over there, untapped opportunities continue to bubble to the surface, and those attracting those in the diaspora to come back home. One of those who has taken the plunge is a young entrepreneur named Naima Adam. Upon returning to the country, to Mogadishu, she tapped into the country's reconstruction boom. As Mogadishu continues to rebuild, Naima and her team continue to provide a necessary commodity, bricks. This is her story.
My name is Naima Adam. I come from England and I started a small business in Mogadishu right now. I paid a visit in Somalia beginning last year. And I quickly learned that there was no good quality material, building materials in Somalia. And then I thought, how could I close that gap and produce those badly needed items in Mogadishu? I didn't have much family or friends here, but nobody said I was crazy, to be honest. It was a wild idea for a mother to do this. But I thought it will be worthwhile in the end. I have spoken to loads of locals and engineers, and I have done a few research. And then I realized they really need it. They need, Mogadishu is rebuilding, and I thought I should not lose that opportunity. The biggest challenge is the lack of support from the Somali government, not supporting new businesses, especially people coming back from abroad. There is no help from the government. You are alone doing it. That was the biggest challenge. The second one is the security of the country. It has improved compared to 10 years ago or 5 years ago, but it has a long way to go. There are loads of unemployed people here, and I was able to bring some engineers and people to train them, and I was quite blessed with that because there was a long queue of people wanting to work but doesn't have a training. They will tell you that they know everything, but you have to select people and you have to train them and they will do the job. Girls that are from abroad, they have different mindset, and I no longer feel that I am any less than a man. And I order them, they do the job for me. I train them, they do the job for me. I don't see any difficulties of being a woman. You can do anything as long as you put your brain into it. Next, I want to be able to buy big land and build houses and sell them to people, really, people who want to come back to the country and buy affordable, good quality houses. That is my main goal. But for now, I'm helping people to supply good material to build houses.
The story there of Naima Adan in Mogadishu. Quick run through currencies here for you. We're looking at the Naira very, very closely. Still trading well outside the target band of the central bank. 168 plus or minus 5% on either end. The Kenyan shilling still around 90 to the dollar as well. Not exactly where it was earlier on, around 90.10, 90.20, but still relatively weak on the day. Here's what we're working on for tomorrow's show. We will be in Zimbabwe. Its 2015 budget will be presented by the Finance Minister Patrick Chinamasa. We'll have the details from Harare. And we'll also be looking at how Egypt's economy has transformed over the years from being mainly based in agriculture and having a huge chunk of state-owned industries. That's it for this edition of the program. Thank you so much for watching. We'd like your feedback. As always, globalbusinessafrica@cctv.com is the relevant email. And of course, when we're not on air, Facebook and Twitter are your ports of call. We'll see you over there. And in the next 23 hours, I'm Raman Yang. Thank you for watching.